Hey guys, I stumbled upon this video, and one of my one of the smartest guys in any room in the world is this guy, and I'm sure I'm pronouncing his name wrong, Chamath P. He was one of the original founders of Facebook, as a lot of you guys may know, or he had left there. You know, he runs his own set of businesses, and he's a big Buffett fan, but he's a very intellectual guy. He's an Indian guy, and you know, at one point he owned 10% of all the Bitcoin in the world because he had bought it at, $5 a coin. This guy's definitely a billionaire. Anyway, this is not him talking right when I hit play, but he is talking. He'll be talking shortly.
There's also an impact on investors, there's an impact on the government, and there's an impact on the banks. Let's just deal with the banks for a second. Commercial real estate developers are hanging on by their fingernails right now. You know, they basically borrowed huge amounts of money to buy commercial real estate when rates were really low, and they did so at high valuations. Now there's been a huge correction on that market, and they cannot pay back those loans, and they can't get refinanced. So what's happening? Well, they're working with the banks to restructure those loans to tack on the interest they can't pay now to the end of the loan, and then the bank will hope and pretend that they'll be able to get paid back one day. It's called extend and pretend. Well, the extend and pretend strategy could work if you believe that rate cuts are coming really soon, because you just need to hold on until the rate cuts are here, and then you can get refinanced at lower rates. But if rates are going to be higher longer, that strategy is not going to work, and you're going to see more and more real estate sponsors throwing in the towel, and banks are going to end up foreclosing on these properties, and you're going to see more and more fire sales. There's a really dramatic example just the other day in St. Louis, a building that was bought a few years ago.
In 2006, it sold for $205 million, and it sold for $3.5 million. This is almost 20 years later, too, guys. Oh, real estate just keeps going up and up and up and up, up and up and up and up. You know, you're an idiot if you think that real estate is always going to go up. These guys are taking 90% haircuts or more. This was, I don't know, over. Some people were taking 99% haircuts.
For $200 million, just fire sale at $2 million. I mean, 99% reduction. This is like .com crash. I assume the equity was completely wiped out. They sold it for $3.5 million, but it's also going to wipe out for the bank that made that loan originally, or bought that loan and is repackaged into CMBS or whatever it was. I would expect that if rates stay higher longer, that's going to create tremendous stress on commercial real estate, and therefore on the regional banking system that made all these loans to commercial real estate developers. So that's knock-on effect number one. Knock-on effect number two is the government's cost of borrowing. The 10-year rate's already risen to 4.5% now, and if rates stay higher longer, as more and more of the government debt rolls, it's going to end up getting refinanced at higher rates. And the need to refinance all this government debt is going to continue to put pressure on the bond markets. And I think this is why Larry is fundamentally pretty bearish on rates going down, is the government's financing costs are so huge, and they continue to grow. We're adding something like $1 trillion of new debt every 100 days. There have been some reports of this.
Yeah, 7.6 trillion.
So this guy talking now is Chamath. And remember, guys, we only take in the U.S. economy is 20 trillion, and in tax revenue, I don't know, I might be incorrect on this, but because I want to say the government typically takes about 20% of the economy in taxes, but I want to say they only took in $2 trillion in taxes. So that would only be about 10% of the U.S. economy. If the economy's 20 trillion and the government's taking 2, that's 10%. During COVID, we spent $6 or $7 trillion. So we spent money we didn't have, well into the future, and we're well past the part of diminishing returns. The production function is land, labor, and capital, and anytime you overuse one of the 3 production functions, eventually there's diminishing returns. And we know now that for every dollar that the government goes into debt, it only adds 30 cents to the GDP, or 35 cents. And but you still got to pay back principal and interest on a dollar, even though that dollar is only worth 35 cents. Anyway, let's listen to Chamath speak here.
Is getting refinanced of old debt in the next 12 months. That 7.6 is sitting around 2%, and now it's going to get bumped up to close to 5%, which adds an incremental $210 billion a year.
They could unplug the country.
Add another 2.10 billion to the debt.
Finance in the next 12 months. Not to mention the deficit, not to mention, et cetera, et cetera.
Right, so the government was extending and pretending as well. They were hoping that rates would go down, continue to grow. We're adding something like $1 trillion of new debt every 100 days. There's been some reports of this.
Yeah, 7.6 trillion is getting refinanced of old debt in the next 12 months. That 7.6 is sitting around 2%, and now it's going to get bumped up to close to 5%, which adds an incremental $210 billion a year of debt service expense just on the debt that's getting refinanced in the next 12 months. Not to mention the deficit, not to mention, et cetera, et cetera.
Right, so the government was extending and pretending as well. They were hoping that rates would go down fast enough that when all of this massive government debt rolls and needs to be refinanced, it'd be done at lower rates, so the interest costs wouldn't swamp us. We're already, I think, at over $1 trillion now of annual interest expense for the federal government.
We are, yeah, and it's going to rise to 1.6 trillion.
So the government is paying $1 trillion in interest. They're only taking in $2 trillion. I might be wrong. Maybe they're taking in more, but I thought taxes only about $2 trillion a year. And they're paying $1 trillion just on interest on the debt. And he just said it's going up to 1.6 trillion.
So it's going to be 60% greater than our defense budget, just servicing the old debt.
We're basically in a classic debt spiral where we're borrowing. Our annual deficit we're at $2 trillion plus now. We're not paying back the principal on the debt. We're not even paying back the interest on the debt. We're borrowing money to pay off all the interest, and then some on top of that. So that's a huge problem for the federal government. And then I think the last piece of this is investors. So what this chart shows is the Fed funds rate basically over the last 75 years. And you can see that it peaked in the early 1980s when Volcker decided to break the back of inflation by jacking up interest rates to 18%. And it was very painful. We had a pretty severe recession, and I think it was 81 or 82, but then the economy came roaring back by 83 and Reagan got elected in 84. In any event, that began a period of declining and low interest rates for investors, again, starting in the mid 80s, and it continued all the way through, I think, the post-GFC period, and then this COVID period where we had zero interest rates for a long period of time. And you can see the last spike we've had was when the Fed decided to jack up rates to 5% in response to inflation. So the fact that we've got this persistent sticky inflation suggests that this whole, you could call it really almost a 40-year period of declining low interest rates may be over. And when interest rates are going down, it creates a huge tailwind to the stock market and the bond market because the discount rate is lower, so stocks and bonds are going to be more valuable. Well, If we're in a long-term environment that's more inflationary and rates have to stay higher longer, that's not great news for investors. It hurts the stock market, and it creates, in the private investing world, like VC and real estate, it creates a much higher hurdle rate. So it's harder for private investors to justify fundraising. So I think it's too early to say that this 40-year trend is over, but I think it could be. And the reason for that is just the huge pressure of government borrowing crowding out private investing, and this sort of ever-present need to keep issuing more and more debt at higher and higher rates to make it more attractive is going to create, I think, very bad conditions for investors.
So Chamath, let me ask you if you concur, given that today the NASDAQ is sitting at an all-time high, what's the disconnect in the market on why investors are buying equities, given that we're likely going to have persistent higher rates, and as a result, multiples should compress, particularly in growth stocks, and why the NASDAQ's kind of firing up?
I think it's important to look at what stocks are actually lifting the NASDAQ, just like what stocks are lifting the S&P 500. And we've seen this. There's a massive dispersion. There's like 7 or 8 companies that matter and 500 odd companies that don't matter much. And so the reason why things go up.
Hey, Speed, if you're actively trading stocks, I'd like to show you how I make an extra $5,000 with just one.
In an environment like that, is irrespective of the economy, money managers are paid to deploy money. And the global amount of total available equities to buy is shrinking. If you think about that, what that means is that the number of dollars is growing, right, linearly, and in some years it seems exponentially. So then a certain percentage of that finds its way into the equity markets, but when the equity markets continue to shrink and there's fewer and fewer things to buy, prices will still go up irrespective of the underlying justification. So I think that the thing is, you can't look at these things as a sign per se. You know, if you look at, as a different example, commodities are up, broadly speaking, 30% since the beginning of the year. I think the reality is the following. Countries are feeling increasingly uncomfortable with the decisions that the United States are making, whether that's its position to keep funding the war in Ukraine, whether that it's the continued instability in the Middle East, whether it's posturing with China, whatever it is. And so every country is now making a very different calculation about what they want to do. And I think how it gets reflected is that they are optimizing for their own economies. And what that yields is each of them trying to make as much money as they can in the short term. And as a country that is a net importer, we are going to feel the price of those decisions as inflation. And I think Sachs is right. Like, that's where we have to start figuring out how we rebalance these decisions from a foreign policy and economic perspective. Because if you don't change something here, all of these countries are basically going to be like, we're on our own. We're going to optimize for ourselves. These countries are basically voting in a way that says we are not being led in a way that we trust. And that unfortunately falls at the feet of the sitting president.
Look, I'm hopeful, as we all are, that work in the tech industry, that new tools and AI and other technologies would have a massive driver on productivity, which net could help even this out. That's the one last great hope. AI obviously viewed as being highly disruptive by non-technologists and deeply concerning, and particularly in DC.
What is that thing that Bill Gates says? Things are overestimated in the short term and deeply underestimated in the long term. That's what AI is.
That's right.
AI is a bunch of, no offense, probabilities and statistics today. So we should debunk this whole thing of like there's some glowing brain somewhere that's capable of doing everything. Doesn't mean that we shouldn't underestimate it being capable of this in 5 or 10 years, which is probably the window in which we have some form of AGI, but today it's not that. And so the great leaps in productivity, Freebird, that you're talking about are probably a 3 to 5 year phenomenon, not a 3 to 5 months. So what Sachs says is right, which is how does the sitting administration votes today? It'll have to make a ton of promises. The problem is it can't really work its way into the economy fast enough come the November election. That's where I think they're in a really tough spot, which means that then, and I hate to be the bearer of bad news, but this is where you have a lot of these wag the dog kind of scenarios that come to mind, because then the only way to really galvanize a populace is to distract them.
Well, I found that very insightful that what was it, $7.6 trillion has to be refinanced this year. And if that $7.6 trillion was financed at 2%, and now they're going to go from 2% to 5%. I mean, add an extra $2 billion to already $1 trillion interest on the debt. That is huge. So yeah, I was right. But it's about 2 trillion. Um, well, that was just the individual taxes. This is a kind of interesting fact. From 68 to 1913, 90% of all federal revenue came from taxes on liquor, beer, wine, and tobacco. All right, so it's closer to 4 trillion, I guess. The government takes in about 4 trillion. So yeah, so that was when I said they took about 20% of the economy. If the economy is 20 trillion, 10% would be 2. So yeah, that sounds a little more. So last year they took in 5 trillion, 4.55, and close to 4.5 again. Like I said, it's been ranging somewhere around 20% for if you stretch this graph out to 100 years. It doesn't matter if it's a Democrat, it doesn't matter if it's a Republican, it doesn't matter if taxes are high, taxes are low. The government takes 20% of the economy basically. But if you only take it in, if your monthly income is 4 trillion or yearly income is 4 trillion a year, and you're paying close to 1.6 trillion on the interest on the debt, that's just not sustainable. And meanwhile, we're giving all our money to all these other countries around the world. But yet our Social Security goes bankrupt in 9 years. And I know they want big corporations to pay more, but most of these big corporations, they're monopolies. So if you tax if you tax a Google, if you tax a Microsoft, if you tax Facebook, McDonald's, I mean, guess what? They're just going to pass those costs on to you. So I mean, it's ridiculous now that, you know, you go out to eat at a fast food place and you're paying 20 damn bucks. That's because of the pricing power they have. But, you know, all these companies, they're trying to pass on all these higher supply chain costs and stuff onto the consumers. But eventually, the consumers are going to be like, fuck you, I'm not going to buy your shit anymore. I'm a switch to an alternative. But the problem is that there's not very many substitutes for housing, for example. There's not very many substitutes for gas. There's not very many substitutes for food. So, I mean, if gas is high, if rent or mortgages are high, food is high, I mean, there's not that many good substitutes. Anyway, thanks for watching.